Hello, you're welcome to FinInvest Niger. My name is Tom Princeville, and I've been investing for the past 20 years. I'm a certified securities and investment practitioner and investment specialist. And in this video, I want to talk about the pros and cons of investing in a mutual fund. The pros and cons of investing in a mutual fund. A mutual fund essentially is a collection of, it's a pool of funds, pool of money that is channeled into a particular fund to be used for investing in the stock market. That particular fund is called mutual fund. You pull money from investors into a single fund, into a fund you will then deploy in the market. That particular pool of fund is called a mutual fund. Let's start with the advantages, the pros of investing in a mutual fund. Number one is professional management. Professional management. These funds are managed by experienced fund managers. They are experienced, they are skillful, they are talented, and they even really delivered returns over the years. So you have an advantage of investing through them rather than doing it yourself as maybe a novice investor. Number two is diversification. When it comes to diversification, this particular strategy reduces risk because you invest in a wide range of securities. Okay, so in case any of the securities, has developed problems, maybe encounter doubts that a downside, in its operation, it will not negatively affect the overall performance of the market, and so your risk is adequately managed because of the overall exposure you have to many stocks in the mutual fund. Number two is accessibility. Accessibility here means it is suitable for small investors with a minimum investment capital. It means I and you can invest in the market as little as 10,000 naira. You have access to invest in a mutual fund. In one of my videos, I discussed extensively about mutual funds you could invest in the Nigerian market. Number four is liquidity. That means that the units, can be easily bought and sold, or redeemed in the market. You could redeem your holding, you can sell your holdings, you can equally buy very easily. So it's readily accessible to those who want to invest in these kinds of funds. Number five is variety of options. It has a variety of options. You have the equity mutual fund, which I discussed in one of my videos. You have the debt fund. You have the hybrid funds. You have the index fund, which I equally discussed in one of my videos as well. And you have some sector-specific funds are also available. They invest in specific sectors of the stock exchange. It could be the banking sector, insurance sector, oil and gas sector, the agricultural sectors. Just name any of them. So you have funds that are kind of specifically invested in those sectors. Number six is risk spreading. Risk spreading. So losses in one security, may not offset gains in others because your risk is widely spread through diversification. If there's a risk attached to a single stock, maybe a single stock or so, maybe one or two stocks underperform, it will not negatively affect the overall performance of the entire portfolio or the entire fund. Number seven is convenience. Number seven here is convenience. So in this case, there's no need for active market monitoring by investors. You as an investor, you simply buy the fund and the fund manager manages the fund for you. So you don't get involved in day-to-day management of the fund. You just buy the fund and you go to rest, and the manager will actively manage these funds on your behalf. So that's where the issue of convenience comes in as an investor. Number 8 is a regulatory oversight. These funds are regulated by the regulatory bodies. In the country here, you have the Securities and Exchange Commission, the SEC. They usually regulates and then provides a kind of covering, for investors. They're not like your usual MMM and CBEX that are not regulated in the markets, and so they have problems. So these funds are adequately regulated by the relevant regulatory body, which is known as SEC. Number 9 is a systematic investment plan. You see, you could choose to invest systematically through these funds. In that case, it encourages a kind of disciplined approach to investing. You may say, well, I want to buy a fund that covers a particular sector. I want to buy a fund that covers a particular industry. I want to buy a fund that covers a particular, investment strategy. So you are like, you systematically, you plan your investments. You invest with discipline and planning and strategy at heart. Number 10 is transparency. You see, these funds are transparent in the sense that they disclose their holdings and their performance. I did a video about mutual funds and I was able to present some figures there. I got those figures from their websites. So they are very transparent. They tell you where they made losses, they tell you where they made profits, they tell you everything you need to know about them. So they are very, very transparent. And because the regulatory body enforces, transparency and disclosure, they virtually have nothing to hide. Just go to their site and you see everything about them. You may decide to invest or not to invest. Then you now come to the cons, the disadvantages of investing in mutual funds. Number 1 here is management fees. Management fees. You can't run away from this particular one. It's not something you can dodge, because the fund managers there, they need to eat, they need salary, they need to take care of their family. So you pay management fee for them managing your money for you. So it is called expense ratio. And unfortunately, it can reduce your overall returns. It eats into your overall returns at the end of the day. Number 2 is there's no guaranteed returns. There's no guarantee that this is the kind of returns you are going to make. No. Performance depends on market conditions. When the market does very well, as a mutual fund investor, you equally perform well. You have better returns. And if the overall market performs poorly, because the funds are invested in the markets, you also have a poor performance as well. Number 3 is market risk. The market is always volatile, and of course is subject to different economic cycle, to boom and bust, to bear, and bull markets. So you are subjected to market risk. That is something that is a very important demerits or cons of investing in a mutual fund. You can't escape market condition. You can't escape market risk. Number 4 is lack of control. Lack of control. So as an investor, you can't really pick individual stocks. You can't control what your manager buys or does not buy for you. You simply give him the money by buying into the fund, and the manager does the stock picking for you. So you lack control as an individual, which is a factor we need to consider if we are inclined towards investing in a mutual fund. Number 5 is underperformance risk. Underperformance risk. So funds may underperform their benchmark. What is called benchmark, that is benchmark serves as a standard, as a comparison. All right. Let's say a particular fund is investing, let's say, has a value or a growth strategy. So a value strategy, based mutual fund will want to, benchmark itself against the value index or the value benchmark. So most of the times, the fund tends to underperform their index, and that's what is called the underperformance risk. That is a particular index does better than the mutual fund, the the mutual fund, the fund is trying to like benchmark against. I hope I'm making myself clear. It's somewhat technical for 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 a beginner, but just keep on watching. You get to understand these things by and by. So we look at number 6 is tax implication. There's this tax implication: capital gains tax and dividends. Capital gains and dividends may be taxable. Capital gains means your return over time, so that returns will be taxed. And when you eventually pay dividends, by the fund itself, your dividends get taxed as well, maybe taxed as well, depending on government policy and jurisdiction. It happens. Number 7 is exit loot. So exit loot simply means when you exit the fund, outside the stipulated period you are expected to hold the fund. The fund manager will charge you a kind of fee. You will charge a fee. It attracts penalty. Okay, let's say you wanted to invest for maybe 3 months or 6 months, and you want to liquidate a position before that particular time. They will charge you a penalty fee, and it's called exit load. Number 8 is over diversification. Some funds are kind of overly diversified. You see a particular fund holding as many as 100 companies, some 80 companies, some 70 companies, some 60 companies. They are over diversified. All right, and so it can dilute future returns. It can dilute, it can kind of, dilute potential, high returns in the future. Because usually the more stocks you hold, the more your performance will mimic the market. There will be nothing really extraordinary about your returns at the end of the day, because essentially you become the market. When you hold too much of funds, too much of securities in the market, you are the market. And being the market, you can't outperform the market, so to say. Number 9 is style drift. Before then, please subscribe to this channel, like and share this video, because I want to reach out to 1 million Nigerians with this investment message. In Nigeria here, less than 4% of the population is invested in stocks. In America, over 40% have investment in the stock market. So let's try and bridge that gap, and I'm depending on your support by doing what? By subscribing to this channel, liking this video, and sharing it out as well. Number 9 is style drift. Sometimes fund managers tend to like change their strategy. There's a value strategy where you buy cheap stocks. There's a growth strategy where you buy expensive growth stocks. There's a momentum strategy where you buy stocks that are just like skyrocketing in price. That's momentum strategy. There is you have different kind of strategies in the markets. Okay, and so some fund managers tend to change their strategies, from time to time, which might present a disadvantage generally, because once you change strategy, it would either positively or negatively impact your result. In that case, you are inculcating risk into the portfolio itself. So number 10 is dependence on fund manager skill. So the performance of a mutual fund, unlike an index fund, is dependent on the skills of the fund manager. The more skillful, the more talented, the more experienced, the more careful, a fund manager is, that is what will determine the returns you are going to make. So everything now boils down on what? Boils down on the capability or excellence of the fund manager managing the fund for you. And that is a very, very big disadvantage compared to index funds in particular.